Simply Financial with Christopher Calandra, Certified Financial Planner, is an innovative, comprehensive, informative, and cutting-edge podcast that discusses financial topics ranging from personal finance, economics, politics, and personal growth. Simply Financial will cover intriguing and thought-provoking questions so that the listener can simply increase their financial IQ.
Thank you for listening today. This is season number 3, episode 41 of the Simply Financial podcast. I'm your host, Christopher Calandra. On today's show, I have with me David Lake, who I've known for quite a while now. He is a CPA in Connecticut with offices in Meriden and Madison. Additionally, he teaches accounting at the collegiate level, and he has a business relationship with us here at Elliott Wealth Management Services. He's part of the team because his role as a CPA sometimes calls for financial planning and investment planning, and in those instances, he refers them to us, and we work on things together, and it delivers a higher level of service to his clients. It's a great working relationship. We've also become very good friends the last couple of years, and I'm lucky to have him on the episode today. Thanks for joining me.
Thanks for having me. Appreciate being here.
So what we're going to talk today is business valuations. And last week's show, I talked about the 3 phases of succession planning. And one of the key elements of that is business valuations. And very often for small businesses, closely held family businesses, they need business valuations done, and often the CPA is in the best position to do that. So you've done that for your clients when it's needed, right?
Yeah. Over the years, I've done dozens of business valuations for the exact reasons that you're talking about.
And they can be tricky, right? Because there's different industries. I know for a financial planning practice, there's certain metrics that are used to help determine a value of a business, and there's certain norms that you'd expect in a transaction where a practice is being sold. But if you're dealing with different industries, you need to familiarize yourself when you're working on a valuation with the industry norms, right?
Correct. I mean, whenever you look at any individualized business, they all have their own nuances to what you're talking about. And because of that, there's 3 different ways to look at a business valuation. There's asset-based, there's current revenues, and a future revenue model. And what you do is you have an understanding or gain an understanding of the business to understand which one to, quote, weight more within your business valuation.
Okay.
So if a business is growing, future revenue is more important than current revenue. If you're a manufacturer, the assets of the business are more important than somebody like myself who just owns a couple computers.
All right. So typically, and let me just say, because I think I jumped ahead, you've also shared with me that you're a CPA, so you're qualified to do valuations, and you have experience doing them for quite a while across multiple different business sizes and industry types. But you're also pursuing a special designation in regards to this. Before we get into my next couple of questions, can you just touch on that? What is the designation?
So similar to a CPA or a certified financial planner, there's what's called a certified valuation advisor analyst. And you have to take an exam. So I'm in the process of studying for that, and I'll take the exam a little later this year. But a big part of that process is being a CPA. So this is like having an addendum to my CPA at the end of...
Because you could get that designation and not be a CPA.
Yes, but it's significantly harder.
Yeah, because it's a lot heavy on the tax side.
Correct.
Understood.
Correct.
Okay, that makes sense. So it's what, CVAA?
CVA.
CVA.
Yep.
Okay. Because CVAA doesn't exactly roll off the tongue.
Right.
All right. So you mentioned the preparation. So in a normal valuation, and I've seen this in play. So listeners, I've kind of gone through this with Dave. We had a meeting with a client of mine that I introduced to Dave a little bit ago. But you basically meet with the business owner?
Meet with the business owner. You look at what they're doing, how they're doing it. You look at tax returns, financial statements, both current and past, and if they have a budget or a future plan, you look at that because all of that comes into play.
You mean like a business plan?
Yeah, or just a budget that goes into the future. I mean, you don't have to have a formalized business plan. Essentially, what we're going to do is somewhat create that through the business valuation.
Okay. So is this done, so the in-person meeting with the business owner, or the principals of the business, typically you're going to meet them like once or twice at the beginning, or could it be multiple times depending on the complexity and size of the business?
It definitely depends on the complexity of the business. Some businesses are, I just did a valuation for a real estate company. Right?
Okay.
So the woman was looking to retire. She had somebody that was interested in buying it. There's not much there other than the value of the name and the number of people she has working under her.
Okay.
So it's that was a one in-person meeting and 4 or 5 phone calls, and then a lot of time with me in the background.
Okay. That's what I wanted to talk about. So let's say you meet with the owner and the principals, ask them about their future plans, what documents they have, business plans they might have, see maybe their business site. You do that. Then you go and then you're going to work on this project. And I know you have some really great resources that help you.
Yeah, I use software out there that really helps the valuation process, because anytime you look at any particular business, we'll use my business as an example. I'm a CPA, so if I just started my practice last year, what I'm going to look at is what do I expect to happen in the future?
Okay.
Not what I'm doing right now. If I'm use the woman I just told you about, who's a realtor, she bought a practice last year, a year before she bought or sold it.
Okay.
So at the end of the day, when I looked at her prior 3 years revenue, which is usually the starting point, the last couple of years don't really matter because
they're not reflective.
They're not reflective of where she is in the current situation and where she expects to be in the future. So you do the 3 different valuations, like I said, asset-based, current revenues, and future revenues, and then based on your knowledge of the business, you add different weightings both within the individual calculations and collective.
Okay, so with the real estate business, and obviously you're not going to give out any privileged information, but did you know or get exposed to any particulars about that industry? Because I mentioned at the beginning, like in my industry, I know there's some metrics that are often used to value financial planning practices. Does the real estate industry have anything that's unique to it in terms of metrics that you got exposed to or knew about even maybe before doing this project?
Yeah, I mean, at the end of the day, but it's very similar to most other businesses.
Yeah.
It's the competition in the area. It's the goodwill in the name that you have, right? You have a good name, I have a good name, this person has a really good name in their town, so there's a value to that. And it's not her name in the practice, it's the name of the agency that she owned, right?
Okay.
So all that comes into play when you're sitting down and adding things up and coming up with a number.
And so other factors could be things like a multiple of sales.
Yeah, so back to your question. So there's a number of, just like a CPA has the IRS code to follow.
Sure.
There is a number of references out there that give you the proper factors.
Okay.
Look at the regionalization of a business, and you take all that into account when you're looking at the valuation as well. So it's not just the numbers, but there's enough information out there, because what has happened is a lot of businesses have compiled the sales of like businesses. So it's no different than continue with the real estate example. When you sell a house, you look at like sales in the area.
Sure.
So there's companies out there that have compiled like sales for industries that you use as a part of your valuation as
now,
well.
do all CPAs have access to these resources that you've told me about, just in our normal course of business dealings, or because you do valuations and have a specialty, if you will, there, that you have access to these resources, or like, are they free? Could somebody just Google this kind of stuff? No, right?
No, I mean, a CPA can gain access to it, but
Sure.
most of them don't. I choose to do it. I really enjoy it. It's a different type of business, and it's fun for me, right? Some people think I'm nuts, but that's all right. So there are resources available, but it's not really available like if I wanted to Google the IRS code.
Okay.
Right? So I have to pay for the resources that I use to help.
All right. And it seems to me, based on my 27 years of experience, that, and I've worked with a lot of small business owners and entrepreneurs over the years, is that they have trouble assigning a value to their business for a few reasons. Number one, it's very personal to them, so that often leads to them overvaluing the business. Yep. So how do you contend with that? Because for a small business owner, they often have a lot of their self-worth and pride, and they created maybe something from nothing, or maybe it's a second-generation business. And so there's a lot wrapped up in the valuation that goes beyond the numbers. How do you explain to them that the value that they may have is not legitimate in the marketplace without offending that personal value?
It's a really fine line. But to the part of the discussion we had a few minutes ago is there's enough metrics out there that I could show and say, based off your current revenue model or current situation, these are the things that we have to file within reason.
Sure.
Right? So remember, the metrics are something to use as a guideline. They're not the steadfast rule. So say that real estate agent is the only person in Southington where you're based. That's going to be the value of that business is going to be considerably greater than the guy who's the next town over who's got five competitors, right? So generally, what happens is you have to bring them in off the ledge and say,
right,
let's look at this with the fine tooth comb, and let's talk about
unemotionally look at the numbers, kind of thing,
and think about what really makes sense. Because just like, again, using a real estate example, if you put a house on the market for $500,000, it's worth $150,000. How many people are going to want to buy it?
None.
Yeah. Right? So you have to put a value on it that makes sense. And that's where the science comes in, because as my professor in grad school, I took a couple classes in this, and he said, listen, there's no definite right answer, but there's answers that are more right than others.
Okay. That's a good way to look at it. I think the other reason why lots of small business owners have trouble valuing it is also because they built the business without the idea of selling it or having to assign a value. It might have been a passion of theirs, or they wanted to be self-employed, pursue the American dream that way. So they never really just thought about it. So they don't really have too much of a frame of reference. That conversation has to be a little bit different, although I imagine it's just an educational conversation of...
Well, actually, you'd be surprised. The clients that I meet that are at the point where they're thinking about a business valuation have actually probably put more time and effort into thinking what the number is than you would imagine. It may be way off base like we've been talking about, but at the end of the day, they have a good idea of what their business is about, and whether or not there's available other businesses that are similar to theirs in the general area. And the general area could be city, county, state, or the country for that matter, depending on what it is. And that's where it gets, to your point, you got to be really cognizant of who the client is and what they're doing and where they're going.
So for people that are listening, especially small business owners, they may not have done a valuation, but let's just talk about some examples of when evaluation is needed. So we've kind of referred to if there's some type of transaction where you're selling the business or passing on the business to somebody else. Clearly, evaluation is often needed to figure out the value, so then you could figure price and terms and all of that stuff, right?
Yeah, there's a million different reasons that one could be needed. A divorce, somebody passed away, so the estate needs a value. Somebody's looking strictly to sell. Somebody's looking to retire. If you're going to install an ESOP plan, you need a valuation to determine what is the price per share.